Well, hello and welcome to the Honolulu Hawaii Housing Report. I'm Patrick ONeill, Principal Broker at Luxury Homes International. And with me today, Hawaii's favorite economist, the one and only Mr. Paul Brewbaker. How are you, Paul?
Okay, Fat Choi.
Tong hei fat
Are we done with
choy.
it?
Yep, we're,
Happy New
we're heading
Year.
off.
This is
Happy
this
New
is still
Year.
January. January is already done, and I haven't gotten anything finished.
I know it's crazy. And then this will kind of be a special report. We're going to look back at 2022. And Paul, I've got some of your predictions you made early in the year. We're going to see how those panned out, and
Oh
then look
no!
at and then look at
Did you write them down?
I went back and listened to the video,
Hmm.
and then we're going to look at some projections into 2023. So let's start with one of your first projections, which
Mm,
was about interest rates. And I'm
mm,
going to, and I know this, you were basing all this upon the Fed's
hmm.
instructions and the Fed's non-target target rate and all their
Oh
forward
no! Now
guidance.
it's a target now. It was a
Now it's a
non-target
target.
target 15 years ago, but today is a
Okay.
target. Yeah.
Okay. It's a target. So based on their target, um, the quote was, you said, rates will rise slowly in 2022 and faster in 2023.
Mm.
I think the Fed maybe got that one a little wrong, but let's take a
No, no,
look at
no. The Fed deliberately went in the opposite direction. They went fast up front, and
right,
they're going to switch now, like this week, to slow.
right. But I mean that was yeah, but the increase was so fast, so sudden. 2022 really became a tale of two halves. You had
Well,
before the rate hikes. Yes,
2022 became 2023, right?
yes,
Because ordinarily they start slowly and then, and as to see whether the rate increase is biting, right, is throttling the excesses in inflation or whatnot. And indeed, in 94, they started out at 25 basis points and they ended up at 75 basis points. But instead, the Fed started out at 75 basis points. And this week, they're literally, I mean, that's the expectation that they'll end up with a 25 basis point increase in the overnight rate after a series of 75 basis point increases. So they literally reversed the conventional order.
yes,
Heartbreaking,
yeah.
heartbreaking. And there's the
Heartbreaking.
picture.
Yeah,
You got the picture right there. You think the world's going to have a 3% mortgage, and all of a sudden it's 7%, and everybody's caught blindsided.
yeah. And we'll see how this plays out in the statistics. It's kind of what everyone in the business has been experiencing over the last 2 months. So this is the 1 year rate. If we look at this is going back 10 year. Think about this.
Mm-hmm.
Someone who's been in real estate for 10 years or less, they
Has
were
never
20,
seen this.
never seen these types of rates,
But
which
wait,
is,
there's more.
wait, wait, there's more. Let's look at the,
Somebody who's been in the business for 40 years has never seen a 400 basis point increase in the 30-year fixed rate mortgage rate like the one we saw from 3% a year ago to 7% in November. Let me say that again. Somebody in the business for 40 years has never seen this large an increase in the mortgage rate.
that quickly.
That no, just in sheer magnitude. Nobody's seen 400 basis points, but certainly nobody's seen it within 1 year.
I guess you'd have to go back to 81, 82, and let's take a look
81.
at the
There you
historic.
go. There you
There it
go.
is. Yes. So
Almost as if what people had in their heads was, OMG, this is the 1970s, which is not. But that's what was in people freaked out that badly. And to give credit to the Fed, they recognized that the conventional slow start approach to this had to be inverted because the inflation. A year ago, we didn't know Russia was going to invade Ukraine. That's another thing that, right? A year ago, we didn't know that the Ukrainian wheat harvest would fail completely, and that oil and natural gas exports from Russia to Western Europe would be cut off utterly. Germany was closing coal-fired utilities because they didn't need the coal anymore, and then their natural gas supply got cut off. So there's a lot that happened after January of last year that
Yeah.
the Fed
Yeah.
the Fed responded the way it had to contain the inflation expectations that began to run amok after the energy shock from the war in Ukraine and the other attendant disruptions, grain markets, and then, Ukraine is one of the world's biggest manufacturing countries in a number of important metals and other areas. People don't think of it as it's a
Yeah.
top 10 kind of a country.
Right. Oh, and going back to the impact on the mortgage rates for homes, one
Yeah.
thing you've been saying consistently is that rates overshot and probably would settle in around low to mid fives. Is that still kind of what you're thinking as we head
Yeah, I
into
think
this year?
I will bet you a mini plate lunch that
Okay.
low stakes bet that the mortgage interest rate will have a 5 handle on it next week.
Yeah. Interesting. Next week.
Yeah.
Wow. Okay. Well, and I've got some good news for buyers as well. I mean, if you look at what the mortgage rates are with a point, paying a
6.13. There
point,
you go.
I know, but paying a point or paying a little bit of extra fees, right now
Sure.
you can get in the low five. So if you're saying the rate is going to dip down into the fives, well, suddenly we're back into the fours with a point or so.
Yeah, no, I actually think that the right number is in the 4 to 5 range, probably at the higher end of the range. But I think it's useful to remember that the range was 4% in the last decade. You just showed it just a second ago. Actually, I have a
Hmm.
version of that. Let's see.
Hmm.
Yeah, there's
Yeah.
a version of what you were showing, and I only have the 6.15 through last week, not the 6.13 or 2 weeks ago. You had the 6.13 through the 26th. It's a weekly measure from Freddie Mac. But
Yeah.
this horizontal line here, this 4% plus or minus, this 4% was the average from 2011 through 2019. So in terms of points of reference, what's in people's head is a 4. And as I say, I think you have to remember for most of the 20 teens, there was lower inflation than expected. The Fed was maintaining a more accommodative monetary policy with quantitative easing for longer than expected. And for all of those reasons, lower than expected inflation, easier money than expected. The long-term interest rates, like 30-year fixed rate mortgage rates, were lower than they would have been had things gone back to an equilibrium, a sort of dynamic, steady state equilibrium, in which the inflation rate was actually 2% instead of no more than 2%, which is what we had last decade.
Yeah.
If you assume that we meet the Fed's goal of inflation by next year, let's say at 2%, and we get into that steady state zone, the autopilot zone, the Goldilocks kind of environment, and have yet another longest expansion in history unless a pandemic shows up, which is what happened in the last 10 years, then the average mortgage rate would probably be 4.75 or something like that. I mean,
Yeah.
four and a
Okay.
half to 5%. Yeah.
All right. Well, let's shift gears and let's just take a quick break. And we come back. We're going to look at the housing statistics just released by the Honolulu Board of Realtors. So stand by.
Mm.
We'll be right back with economist
Yeah.
Paul Brewbaker. Back to the Hawaii Housing Report with economist Paul Brewbaker. By the way, if you're enjoying this information, please give Paul a thumbs up down below. It really means a lot to him. And if you want to get next month's report, subscribe to this channel. We do one every month that comes out. So, Paul, we're going to jump into the Honolulu Board of Realtors information that was released recently. And these are lagging statistics, as we know. It's
Well,
really confirming what everyone in the industry
yeah,
knew in the past month, right?
they lived it.
So definitely sales are down, inventory is growing, and I think that's creating some downward pressure on prices. But let's shoot over to
Mhm.
the statistics themselves. 'Cause, 'themselves. 'Cause, 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 ' Okay, so if we take a look here, this is closed sales, and we look
Mm.
at single family home compared to last year, it's down nearly half, a double, right? We were almost at 400 last year, only at 200 this year. Condo sales down 40%. These are dramatic numbers. And if I push that against the active inventory, if we look at active inventory on single family homes, it's nearly double. That's crazy. Looking at the closed sales down, active inventory up, of course, we're going to start to see some buildup in inventory. And this will start to create some downward pressure on pricing. And this is something you and I look at quite often, months of remaining inventory. The numbers have increased, nearly double on the condos and over double for single family homes. But at 2.1, 2.2 months of remaining inventory, that seems like it's still a tight market for a buyer to be out there. I'll probably
Barely
leave.
enough, barely enough breathing room for the escrow company to get the work done. You know what I mean? It's like the title and escrow guys are all like, finally, we have 2 months in which to complete our work instead of one.
I guess that's one way of looking at it. Yeah, I don't know. I mean, when you drop volume in half of what it was, that's real consequences. And I suppose that's what the Fed wanted to do, right? To
Well,
slow down
look, here's
some
an
segment.
analogy. Yeah, exactly. They wanted to throttle economic activity enough so that the excess demand, think of a balloon inflating the they want to reduce the pressure that was inflating the economy, showing up in prices because goods could not respond. Goods production could not respond, but goods demand was going off the charts. Unfortunately, the tools that they have affect the economy mostly through investment and other interest sensitive economic activities. And the big dog for household investments is housing, right? Yes, it affected automobiles, the supply chains for which were disrupted by COVID, and
Those are
to,
supply chain. Those are supply chain issues. But
no, no,
the
no. But the point is the demand after hiding out for a year, everybody wanted a new pickup truck, except the supply
Mhm.
chain for the parts, the component parts
Yes,
for the truck was disarticulated by the
sure.
pandemic. Um, we never build enough. Well, we used to build enough homes in Hawaii, but we don't now, and we probably not won't in my
Right.
lifetime. So the pressure is even more acute in Hawaii, where as we saw after the pandemic, there was a weird shift in the composition of demand towards detached dwellings, towards suburbs and exurbs and zoom towns,
Right. Right.
and but so we're paying more attention to the texture, the composition
Well,
of demand than the sheer
yeah.
volume.
But well,
But the
certainly the
Fed's
volume is down substantially,
big
and it
time,
is
and that's
directly
I was just
related to the mortgage interest rates, which
that
is
and
what,
that's
yeah,
all the Fed has is the blunt instrument of the mortgage interest rate, so it hammers the housing market specifically.
right. And now you and I were talking earlier. You had a very interesting slide about the sales volume, the number of properties sold, and it looked
Yeah,
similar
you're
to
just pumping
another.
me up because they're your data.
That's right.
You sent me the data an hour
No,
ago,
you're
but this,
welcome. You're welcome. But this
but
is
you're right. These are the board's data. The only thing we didn't have time to do was put down at the footnote, mahalo to the Honolulu Board of Realtors for the data. And the point you and I were just talking about, and then the one you want me to make now, the point we were just talking about is that while it looks like a crushing, and is a crushing 40% or whatever decrease year over year, we've the same people who've been real estate professionals for 40 years and have never seen a 400 basis point increase in the mortgage interest rate also have lived these massive cyclical changes in sales volumes, the roller coasters of the Japan bubble and the subprime bubble. We're talking about single family sales going from fewer than 2,000 to almost 5,000, and condo sales going from 2,000 to 8,000 between the late 1990s and the
when
early,
and when you look at
2004,
the when you look
2005.
at the when you look at the corrections coming off of those, same thing. You're
Yeah,
seeing it drop in, in half.
yeah, 40%, that's nothing. Try
Yeah.
minus, whatever. I mean, that's
Yes.
what the hell is
Right.
that from 8 to 3.5? That's got to be a large
So,
number.
so one possibility is we see a decline like we do after the subprime bubble. I know you don't think that's going to happen,
Well,
or
no, I mean, we're seeing what we were going to see because we didn't really have
yeah,
a bubble in the 20 teens. But what we do have right now, by the Fed slamming on the brakes, raising rates, and just as we say, hauling out the blunt instrument to throttle the economic activity over which they do have an influence, and that's mostly housing, is the same thing we saw in 1994 when they tried to do the same thing in the reverse order, slowly raising interest rates at first and then ending with 75 basis point increases at the end of 1994 to engineer a soft landing, a recession free deceleration in economic activity in the mid 1990s. And look at the change in single family home sales volume at that time compared to the change we've just experienced in the previous 12 months compared to 1 year earlier,
yeah,
with the opposite sequencing, the large
right.
interest rate increases up front to just slam on the brakes. And then this week, the expectation that Jay Powell and the Federal Reserve Open Market Committee, when it meets on Tuesday and Wednesday, will switch to smaller 25 basis point increases for now and maybe in the remaining um, months of the first half of this year. Nobody expects,
Yeah.
and the Fed doesn't expect that the overnight rate will go much over 5% if it does at
Yes.
all.
And Paul, going back to 1995, that
Yeah.
was the Thumbs Up Hawaii campaign.
Yeah.
Remember that? That was at the depth. And I want to say you, as we were coming out of that period, were one of the few saying, hey, get ready. The housing market is going to go through an increase. I remember going to your presentation.
Well,
No,
yeah.
I remember, and I
Yeah,
remember you
you're right.
actually throwing out a date. You remember that the outer
Well,
at the outer island
that
one, right?
yeah, that was a little later. I have to let's be accurate about
Yes.
the mid
Okay.
1990s because I was too optimistic at that time. Although yes, if you bought any piece of raw dirt or lava in Hawaii around 1998, you would have been happy 10 years later.
Right.
It did. The 90s was much worse a bad hair decade by the end of the decade for Hawaii
It was
than
tough. That was a really tough time in
because
real
not only were we going through the bottom of the U, as you see here in these
estate.
charts on sales volumes, and for realtors, they just got through the Japan bubble, and all of a sudden the whole thing went into reverse. Not all of a
Hmm.
sudden, for the next 10 years,
Right.
things went into reverse. But
Tough.
not only did that happen, but everywhere else, people were making dot coms. That's the other thing that happened in 1994, 1995. A team of nerds at Bank of Hawaii, where I was hanging out, we coded BOH.com. I mean, we had guys coding in hypertext markup language, HTML, BOH.com, which if we'd been
Mhm.
real marketing geniuses, we would have called bankofhawaii.com. And instead, we were nerds, so we used the NYSE stock
I think
ticker.
it
So,
worked out well. Somehow it worked out well for
uh,
that organization. So,
so,
well,
so the lack of a bubble coming into this means that we don't have a massive crash and burn. But it is
yeah,
remarkable that the Fed's trying to engineer a soft landing now, just as then, and it's had about the same impact on single family home sales. Even condos have held up remarkably well. My
yeah.
sense of things is that looks relatively resilient. I mean, it's gnarly. It's been a tough
Especially when you
winter.
look at
It's not
that
going to,
long term, when you look at the long term trend line,
relative to the
it's
long-term
it's
trend.
off, but it's not far off.
Well, and
But
it's not the huge roller, it's not going up and then coming down on the back end of
yeah,
the roller
and
coaster.
and I'll point out, although the inventory is up, we are still below pre-pandemic levels, and there's maybe a whole different area of socioeconomic things that are driving that. Not 100% clear what it is, but that's certainly the case. So, hey, Paul, let's
Yeah.
take a quick break and we come back. Let's look at what the future holds by looking at pending sales. And then we're going to look
Okay.
at the pricing, including what was your prediction of pricing 1 year ago today and where did we end up? So stand by. We'll be right
I'm
back with
sorry you
Economist
wrote
Paul
that down.
Brubaker.
You bum. You had to remind me.
I have to remind you. Okay, we'll be right back. Okay, and we're back with economist Paul Brubaker. And Paul, I wanted to tell you a big thank you to you and your team using that deep learning bio algorithm, whatever you used last month, in predicting the football game in Orlando. Florida State Seminoles
Oh,
were victorious over the Oklahoma Sooners as predicted. So well done, much to the chagrin of our mutual friend.
thank the
But you guys
psychic hotline.
okay, psychic hotline. I thought it was your
Yeah, no,
team, your PhD
that's my
team.
team. Yeah.
Okay, all right. So listen, we're going to jump into pending sales, see what the future holds, and then we're going to take a look at home prices as well. So going back, the information from the Honolulu Board of Realtors, pending sales down, we can see it
Mm.
41%, 43%. This is the eighth consecutive month pending sales have been trending down. Not a surprise, but this is really what the future holds right now in the short term. I don't see anything's really going to shift this around. Do you?
Yeah, but I would emphasize, in the short term, as in, so my son in Boulder woke up this morning to -4 degrees, and right, and the forecast is tomorrow it'll be +3 degrees. You know what I mean? So try not to get too hung up on what's happening right now, which is people hiding out in their house, not listing, not planning to move in the near term, either because it's too cold outside and they're going to wait out the snowfall in the winter, or because at 6 or 7%, it's still an uncongenial interest rate environment for housing transactions. And if you wait 6 months in Boulder, Colorado, it'll be summer. And if you wait six
Mhm.
months in Honolulu, interest rates may come down to a number in the fives
Right.
and the economic prospects or the prospects for the housing market
Yeah.
specifically will have come to a point where the sellers will come back to the table.
Yeah. Well, I mean, right now, so we know next month it's going to be more of the same. Looking again at the short term based on this
Sure.
pending sale trend.
Yeah.
Now, did you tell your son how cold you were here in Hawaii? Because it got down to, what was it, 72 degrees? You had your winter parka out.
He says as he wears his jacket, yes, I
Yeah.
took off my sweatshirt before we started this recording.
You were cleaning out coconuts and he was shoveling milk and you're shoveling snow and you're complaining about the weather.
Yeah.
Okay, so I wanted to go to this. This was Paul Brubaker's
Mm,
prediction for pricing. Okay, this was
okay.
Ja-
Let's have
January
it.
last year. January last year, you said, quote, median price will be at about 1.1 million.
For the
Paul,
year or for
you said for the year. And I want to tell you, we ended
okay.
at 1,105,000. You were off by $5,000. If you were in the prices right, you would have won the trip to
Yeah.
Acapulco and the car.
Well, I'd rather win the house, but thank you. Appreciate
Okay,
it.
yeah.
Um,
But
it
yeah, yeah,
proof that it's better to be lucky than smart, by the way.
don't know about that. So let's go back and we're going to take a look now at the pricing statistics. So median price.
Mm,
Um, so here we are. This is year over year. It's just rather flat.
hmm.
The median price that I was referring to is the year to date, which is down at the bottom left. The median sales price at the
Sure.
105,
Yeah.
which is, we gave you the benefit of the doubt there that you're right there. Um, I thought it was interesting to look back at what last December
Hmm.
looked like
Hmm.
in the price
Hmm.
appreciation. Condos, not that much change, but single family homes, we're looking at 20% price appreciation. We talked about that
Hmm.
endlessly, and
Hmm.
now we're going flat. Do you think this is sort of the new normal as we go forward on
Let's
pricing?
put that slide back up because it's important to start there so that I can jump in a second to
Mhm.
develop a thought here. Look at the December 2020 prices and then December 2021 and then December 2022. So on the single family side, you have an 870, right? In December 2020,
Right.
870,000. 1 year later, 1.05 million. 1 year
Right.
later, 1.05 million. So what that's telling me is that big jump from December, right? This is after COVID has come upon us. This is after the state has locked down the economy and then and simultaneously imposed a travel quarantine for 6 months while we sort out pre-flight testing protocols to reopen the economy with some safety guardrails in place from a public health standpoint. And within the year after vaccination, we're looking at, right by December 2021, we're looking at a huge increase of 20%, 21%, which in the past was associated with those bubbles. The Japan
Right.
20% per year is
The only
kind of a
time we've seen
bubble.
that was
Yeah,
Japanese bubble period and the subprime.
there you go. But what's interesting about the last 12 months or the 12 months for which we now have most recent data is it looks like zero, and it is, but what happened in between is where all the action is. And so we need to
Right.
think about that. On the condo side, however, 455, 485, 502.5. 455, 485, that's a sequence, a stepping up from 450 to 500 over a 2 year period. And I wonder what it was at the end of 2019. I'm going to guess 428. That is a steady progression in prices on the condo side versus a big move and then an overshoot, as we could see in the monthly
Yeah.
data,
And
taking
and
us
those
back.
and those single digit increases, that's what we saw in the 10 years prior, right? We were in
Well,
those
yes,
4%, that 5% range,
4%,
like a
5%,
slow,
for
slow.
year
This just
after
seemed
year.
to be chugging right along on that trend line to some
And
extent.
both of them were chugging at 4 to 5% until the pandemic came. And so the
Right.
point I want to make here and why we need to think about the 2020s, we need to confront this question in terms of the environment, that to, the to expectations for the environment to yet to unfold is, was that something that was really a bubble as we saw in the past? 20%, that's a bubble, yes, no? Or is it something that's uniquely associated with the pandemic, its after effects? And if so, whether we just get back on the escalator? I'm thinking it's the latter. So you'll remember this slide, single family home sales in 2020. That first year we were talking about where prices erupted and we were figuring out the protocols and then rolling out the vaccines. And the eruption occurred with a very specific spatial pattern. East Honolulu, Windward Oahu, North Shore, the Highlands, Makakilo, Mililani, were the places where people were moving to and prices were rising, and the demand was shifting towards, and then shifting away from the urban core. That sounds like a very right, the so-called
Mhm.
donut effect. The pressure moves out from the center to the periphery because people didn't have to commute anymore. Some people began working remotely and realized very quickly they could do this forever. Whereas
Yeah.
in 2022, the backwash, the pressure, the the preference shift reverted back to the urban core from the more suburban and exurban neighborhoods. And with that backwash, what we saw, these are again just single family homes, we saw across the two market segments a very different experience. So the overshoot in valuations was in the single family detached dwelling market segment, whereas condominiums just kind of stepped up back up to the path they had been on previously, that 450, 480, 500. And if you were to ask me, as I imagine you will by the end of this recording, what I would see by the end of 2023, my bet would be on something like, where are we now? What did we say?
Well, yeah, but
50?
looking at the trend, I mean, going back to a 4 or 5% price
Yeah,
appreciation
yeah,
for
yeah.
condos, and
That's
then
correct.
perhaps single family, we see something reverting back to that long-term trend
And
line,
that's
or
that's the that's the key difference. The condo convergence hypothesis would be just getting back to the neighborhood of the escalator from
right,
below, if anything. Whereas for the single family segment, it might mean sort of drifting for a while before the
yeah,
the the trend catches up. That is,
and yeah.
1.1 million might still be the price at the end of 2024.
Oh, interesting. Anecdotally, we see price reductions on the single family home everywhere.
Yeah.
Inventory piling up,
Well,
not selling.
if you really have to sell, but as you also showed, the inventory pilot means that the absorption is not there, so the listings are probably down as much.
Right. That's right. That's right. Okay, well, Paul, let's go to my favorite segment, which is the lightning round. These are double bonus points for you if you get them right.
Okay.
Uh, okay. And by the way, if you're watching this, please give Paul a thumbs up down below.
I
Consider
I don't know what
subscribing to
happens
the
to the
channel.
thumbs, so I apologize if I haven't responded to anybody with a mahalo.
Paul's trying to build up his social media clout.
I
So yeah.
like I
Okay.
say,
All right.
I don't know what happens to my likes.
Okay, so let's go lightning round. So these are your predictions, Paul.
Mm,
For next January, 1 year from today, inflation higher, lower, about the same.
lower,
Mortgage interest rates higher, lower, about the same.
lower.
Single family home prices higher, lower, about the same.
About the same, but they might undershoot for a while before they find a footing.
Okay. And
You know,
condo prices higher, lower, about the same.
higher.
All right. Let me check with the
Ding,
judges. Yes, you won. That's it. You've gotten them all correct again.
ding, 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 ding.
So we will see. Paul, it is always such a pleasure to speak with you and get your insights in all of these things. Uh,
Thanks,
it,
Patrick.
yeah, it really is a joy. Again, everyone, hope you enjoyed it. Subscribe to the channel. Make sure you get next month's report with economist Paul Brewbaker. So everybody, stay safe. We'll see you soon, and aloha.
Stay warm.
Stay warm.